Hello Mavericks, how's it going? This is Rob Reinhold. This is the Trading Room. We just got done with November options expiration, which means we've closed the books for the month of November. We'll do the accounting on Monday, payouts on Tuesday, level advancements on Wednesday, and we have one more month left for the end of the year, and then we all start again. So let's jump into this week. In this session, we've been going over what happened. We're going to go through the sectors. We're going to score them all from +3 to -3. And we're going to see that we have a major shift from a bull market to a bearish, not heavily bearish, but a mild bear market.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, let's take a look back at what happened this last week. We continue to get selling in the markets, and it's really about the high value AI names. These are really selling off. We've seen sell-offs 30, 40, 50% in some of the second and third tier names. We're down about 10 to 15% on the tier 1 names like NVIDIA, Microsoft, stuff like that. This week we had NVIDIA earnings, and I got to tell you what, the earnings were a knockout. It was an amazing report. The stock and the market gapped up. The market was up 2% when the bell opened. By the end of the day, the market was down 2%. That's a 4% intraday reversal, and it just goes to show that yes, the good news has been priced in, and these things are just out of favor right now. So we're seeing selling on rallies. Remember, it used to be buying on sell-offs and then closing at the high. Now it's selling on any rallies and closing near the lows. With that being said, there are still buyers at the lows. We're still getting some decent bounces, so it's not like a cascade of margin selling that's just pushing us down. It's not that intense at the moment. We also got some really wild swings in the projections for a December rate cut. When the week started, it was about 60%. And then the government announced that they are going to be combining the October and November jobs reports into one report since the government was closed. But they wouldn't be ready for that report until like December 16th. The problem is the Fed meets a week before that, which says the Fed was not going to have the jobs report before they met. And so a lot of people said, oh, there's less of a chance of a cut. So we went from like 60% all the way down to like 32, 33%. And then we had a couple of Fed speakers come out who did not vote for a cut last time. It said they're definitely going to vote for a cut this time. And we ended up closing up right around 70% odds. The bond market was kind of wild this week, repricing all of this from, hey, there's going to be no cut to now there's going to be a cut. It was actually quite intense, but bonds really didn't go anywhere at the end of the day. The dollar strengthened, bonds are definitely off their low. So the markets are digesting all of this. We finally have some economic news to talk about. The government released September's payrolls report, and the numbers came in much better than expected. 119,000 jobs, estimated at 53. However, they did revise August jobs down by about 40,000. So if you take that out of the equation, instead of beating by 60,000, we only beat by about 20,000 jobs, which really isn't that big of a deal. That's pretty flat overall. The market initially took this as good news, and then the selling just continued to hit the street. So it's going to be about 2 to 3 more weeks before we get consistent economic reports from the government. But we definitely did get some decent news out of the September numbers. What does that mean for the market? Market's in a bad mood. I love to say that because literally the market does have a mood. And we use the term sentiment at Maverick. When sentiment is bullish, you ignore bad news and you celebrate good news. When the sentiment is bearish, you focus on the bad news and you ignore the good news. And that's exactly where we are. We have definitely gone from a bullish to a bearish sentiment. Dow and S&P down 2%. Qs got hammered, down 3%. Technology was down 5%. But look at the Russell. And we're going to take a look at both the RSP and the SPY like we've been doing lately. And you're going to see that the rest of the market outside of the AI names, it's weak, but it's not that bad. Bitcoin absolutely hammered again. This is the second week in a row. It's down over 10%. Bitcoin has lost a big bunch of its value from the top. We're going to look at two charts here. We're going to look at the SPX. So this is the S&P 500, but it's weighted towards how big companies are. The biggest companies had the biggest reversals this week. This was Thursday's candle after the gap up, and you can see it's nasty. But I want you to take a look at just these last 6 candles. Take a look at the wicks. There's lots of upper wicks, which means that all rallies are being sold. But we also have lots of lower wicks, which tells us that sell-offs are being bought. But the overall direction is lower. We now have moving averages starting to turn. We are below the 50-day moving average, and we are sitting right at a really key support level at 65.50. That is just a very key support level. Okay, where are we? This market could easily bounce up, bounce all the way up to the 50-day moving average. But if it fails there, that's going to be a confirmation that this market is no longer in a bull market. Or if we just simply base for a little bit and break down below 65.50, again, that's telling us that that is a bearish market. This market will need to recover and go above the 50-day moving average, have a pullback, and then hold it before we are back to a bullish market. So that was the end. That was the end of bullishness, meaning that you cannot any longer count on the bull market continuing to make new highs every week, 2 weeks, 3 weeks, like you have over the last couple of months. We are in a different market regime. Let's now go to the RSP. Now look, the RSP is also bearish. We have sloping moving averages to the downside, and it never really got that big run. But let's take a look at Friday's candle. Friday's candle basically recovered everything it lost on Thursday. And again, we had a down day on Monday, but outside of that, the last 4 days, they've been higher. They've actually gone higher here. So we're still seeing the intense selling in the Magnificent 11 that make up 40% of the S&P. But the rest of the market, I'm not going to say it's doing great. It's still falling, but it's definitely not as intense as everything else. And the heat map is just going to show you this visually. Intense selling. Intense selling across the board. Google's the only thing that was up this week on news about Warren Buffett, Berkshire Hathaway taking a stake. Financials were also quite weak. Take a look at financials. They were weak as well. But if we take out this whole left side and this little block up here, I want you to take a look at everything else. Everything else looked mixed. It doesn't look great. It just looks mixed. So what does that mean going forward? I think we're going to see more of the same. We are mildly bearish now. If I was a younger version of myself, there's a saying in the market. There are old traders and there are bold traders, but there is no such thing as old, bold traders. My first couple years of trading, I would have already been heavily short because I love to short. I love when markets break down. They happen very quickly and it's big returns. I would have already been heavily short. However, there were times where I got my face ripped off by the market having a rally. I no longer am that volatile trader. I am now looking at, okay, we are definitely not going higher at this point, but we're not crashing either. There's still buyers out there. There's still people buying. So I think we have to look at This is going to be mildly bearish, but with high volatility. Now, what does high volatility mean? It means that stops are more likely to get triggered. It means that you're going to have a position that you think it looks great one day, and then it looks like absolute dog shit the next day, and then it ends up working out in the end. That's where we are in this market. If you don't like high volatility, if your trading is either you use tight stops or you don't use stops at all and you try to figure out when you should get out, don't trade. Don't trade these markets because it's going to put you in a position. There's going to be days like Thursday where it gapped up 2%. And if you were short, you're like, oh my gosh, I got to get out. And then if you were long, you're like, oh, this is great. It saved me. And then it falls 4% that day. And at the end, you say, oh, I got to get out. And then Friday is a nice bounce back. Do not trade if you are not using strategies that can sit through volatility. Now, let's talk about this week. This week is a historically bullish week. It's one of the most bullish weeks out of the year. I think there's one other week that's more bullish historically, and that's the week after Christmas. This week has been up 70% of the time over the last 50 years. The average return is about 0.2%. Okay. Again, these are just historical metrics. That means that 3 out of 10 times, it's a down week. Could this be one of those 3 out of 10? Absolutely. But I really think the setup here, we just had this freak out. And I think as long as the market doesn't really freak out over the weekend, I could see Monday and Tuesday people start to nibble. And again, if the low volume is there and there's not any real serious selling, I could see a little bit of nibbling this next week. I could see next week being a decent little bounce. That being said, I think that bounce gets sold into pretty hard. So I have no idea what's going to happen. This is just my opinion, but I think we have a nice little backdrop for a possible bounce at the first part of the week. But again, I wouldn't trust it. I wouldn't trust it saying, oh, it's now safe to get back in the bullish side. No, we need to get above the moving averages, pull back, stabilize, and then move higher. The markets are closed Thursday, and we have a half day on Friday, so the market will close at 1 p.m. So if you do have November 28th options, make sure you have them closed out by 1 p.m. on Friday. There's no reason to talk about these because none of these are going to be released, except for this Richmond Manufacturing Index because it's not a government one. The government numbers are still not going to be out for the next couple of weeks. So where does this leave us with our score? We're a -1. Now, why not a -2? I actually had a trader ask me that, like, hey, Rob, why don't you go to a -2? You can move very, very quickly if you want. And what I mean by that is that every single day, you could rescore the market. And based on where it is that day, you might be at -2 one day and -1. But just take a look at like the chart. On Thursday morning, if you scored the markets Thursday morning, you were at a 0. If you scored it at the end of the day, you were at a -2. If you scored it over here, you're at a -1. So I don't love to get so into the details. I like to step out, and it's a dumb term, but I always like to say this. I kind of like to make my eyes fuzzy. Like, make them fuzzy to where I can't really see all the extreme detail and just be like, hey, this is about a -1 here. We just touched the 50-day moving average literally less than 24 hours ago. So I'm not really quick to just make it automatic. So I'm going to go to a -1, mildly bearish, but I do think this is a week that we could get a little bounce out of. So that means that if I'm looking to add shorts, I might be a little patient on Monday, Tuesday, and add those on Wednesday or Friday or even next week. We'll wait and have to see what happens over the weekend, but I'm looking at a small little bounce here this week. I think the seasonality patterns are going to help it recover a bit. All right, let's take a look at our sectors and see where we are going to go hunt. Sector performance this week, best sector was our +3 sector. We only had one +3 sector, healthcare. If you've been in healthcare, you haven't noticed that there's a bearish market going on. What was the worst? Technology finally gave it up. Technology was at a +1 last week. It was holding up much better than everything else. Finally gave it up. Industrials, financials, consumers, these are called cyclicals, meaning that they're very cyclical with the economy. When the economy slows down, these typically fall quite a bit. So technology, industrials, financials, consumer, these are cyclicals, and they are not looking all that good right now. Let's take a look at all of these, score them from +3 to -3, and we'll get our sectors going here. Utilities, okay, we're to 0. We're just stuck right there in the middle. One moving average is going up, one's going down. We're not going anywhere. Utilities is a 0. Communications services was a -2 last week, and frankly, -2 this week. You can look at this and say, hey, it didn't go down. And that might be some good news because the market was down and this sector was actually flat. However, look at the candles. You can see every single rally got sold. Yes, there were some buyers in there, but for the most part, this is still remaining a -2 on the weak side. Next up is real estate, and you can see it's just hanging out at the 20-day moving averages below the 50. They're sloping downward, but it's not a real heavy downward move. So again, -1 in real estate. If you've been bullish in healthcare, you have not noticed that the market is weak at all. Healthcare looks great, high base, breakout on Friday. Looks like this is the place to be. When is this going to end? I have no idea. No one does. But here's the thing I know about trends. I've seen a lot of trends over my 30 years. They usually keep going further than you think. So if you think it's over, you're probably wrong. There probably has more to go in it. So we're going to stay long this sector. Here we have the industrials. Now it weakened. Industrials was a 0 last week. It was just hanging out right here in the middle. But you could see we just broke down below the October lows. Not great candles all through the week, selling most of the week. We also have financials here, did the same thing. They were holding up here and they finally broke down. Not a great week at all for financials. It goes to -2. And the biggest selling this week was in the consumer. The consumer broke down the most of all, and you can see we broke early on the week. And look at these candles. These are terrible candles. Yes, we got a green candle finally on Friday, but these candles are terrible. And gap down and sell off, gap up and sell off, gap up and sell off. Every single time, not great. -3 in consumer. Consumer staples, however, strengthened. We were at a -2 on this, and this sector has worked its way back into being a neutral sector. Technology, it was holding on. I told you last week, it's holding on. We're right there. Let's see what happens, and you can see it broke. It broke. And take a look at Friday's candle. That is not a great candle when you look at all the other sectors. So this is going to go to a -2. Materials, -2 still. That's what it was last week. Friday's candle was a good candle. I mean, take a look at it. It's closed at Thursday's high or Thursday's open. That's a decent candle. For the week, it actually held in quite nicely, but it's not bullish. So it's still a bearish sector, but if there is going to be a bounce this week, it probably is a little bit stronger in this sector. And then energy. Energy went from a +2 down to a +1. We just pulled back here to the moving averages. Good candles here. Gap down, run. Gap down, run. Gap up and sell off. Gap up, run a little bit. It's not super strong, but it's holding in there. This was the scoreboard last week, and we got the biggest move. Consumer went from -1 to -3. And then we had our cyclical stocks, industrials, financials, tech. They all moved down to a -2. Staples moved up to a 0. And then we've got energy down a little bit. So here we are. Healthcare, the clear winner. Energy, maybe it's going to be a little bit stronger and weaker, but everything else is pretty much on the weak side. Let's take a look at where we were last week. We had 8 trades on the board, and we exited 5 of those trades. So we had SRE in the utility sector, and you know what? We had a +2 trade on, and the stock basically closed where we opened the position. So since that was a +2, it was a delta trade with a negative theta. It was a very small loss. Financials, we did a sideways trade on AIG and it moved out of our range for a max loss. We had a bull call spread on AEO. That hit for a max gain. We had materials. We had Wheaton Precious Minerals, WPM. That was a small gain. And then our energy trade was a diagonal call spread, PBF, and we exited that for a small loss. So 3 losses, 2 gains. Wasn't a great way to end the month, but overall, November was a really nice month for this strategy. So where are we now? We are at a -1. I've been talking here over the last couple of weeks about how much I love this strategy, that it saves me from being overly reactive to the market. Because remember, about a month and a half ago, when there were some tariff scares, it was like against China, I think, and the market had a huge drop on Friday. And I said, I'm so happy because as a young trader, I would have gotten very bearish because that's how I felt at the moment. But the slots kept me safe. We have been either a +1 or a +2 for the last month or two. And it has kept me from getting too bearish. And I was very happy because the market tended to be fairly bullish until like the last 2 to 3 weeks. We finally are to a score where we now have more bearish slots open to us. So now it's telling us, okay, now you can get a little bit more bearish, but it's only -1, so it's not going to let you get too bearish. One of the things you have control over in this system is how much capital you have out there. When things are clear, I like to have a lot of capital out. When things are trending, they're moving, it's clear where it's going, I like to have a lot of capital out. When we are at these inflection points, when I don't really know and it's not as clear, I like to have less capital out. So at this point, I'm putting out 4 trades. I'm going to have a total of 7 trades out there. I can have up to 15. I don't want 15 trades in this environment. I'm going to be putting a -1 trade in industrials financials. I'm going to do a neutral trade in utilities, and I'm going to do a slight bull down in energy. So let's go ahead and take a look at some of those potential trades.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
All right, let's start out with the utility sector. All right, I wanted to do a sideways trade in the energy sector, and here we have NRG. All right, now at this point, again, this looked like a high base. We broke out and we failed and we just fell back in there. Could this still be basing? The answer is yes, it could still be basing and then breaking out to new highs. But at this point, I think it's definitely got some technical damage to it to makes it more of a sideways than a base. Again, we don't want to do sideways on basing stocks. This one to me looks definitely more sideways, and I love the fact that we came down, hit the bottom of the range, got a hammer candle. So I'm looking for this to go right back up into this range here. So this one is going to be slightly bullish. So I'm looking at a December 5th, 2 weeks out, 158, 166, 174. So right in here, that means my profit window is going to be right about here. So we need to get a little bit of bullish price action, but I don't think it's got enough power to break out and run to the upside in this kind of market. Could it break down? Yes, that's the most likely scenario. If it doesn't stay in this range, it's probably going to break down. But I like this trade and I like this sector as a sideways. In industrials, I want it to be a -1. Remember, a -1 means we don't need a fast mover. We're not even trying for that. We just want something that's going to stay weak. And here we have Alaska Air Group, Alaska Airlines. And again, falls, rallies, falls. Okay, so we're in a rally. Where could this rally go? Could this rally go to the 20-day moving average? Sure. Could it go to prior resistance? Sure. I would love to be able to get one or two more little up days, and then maybe on Wednesday, get a red candle, take my entry here. I like this one because it's likely going to this new low down here. The trend looks intact. The trend has been bearish for a long time, much longer than the market's been bearish. This one should continue to move to the downside. So I'm looking at December 19th. This only had monthlies. I'm looking at the 42.39. So I'm going to be looking right here. I just need this thing to stay in this area. It's going to be a profitable trade if it stays down. Look, if it breaks back up to the upside and becomes an uptrend, we've got our max loss in there on this spread. Next, in financials, I also wanted to be a -1. Again, looking for something that's just really weak, has been weak for a while. Now that the sector's weakening, we've got this long base here and it's holding on. I don't need this thing to really fall and collapse. I just need this thing to not go up. I'm looking at the December 5th, 39.36. So as you can see here, I don't care if it stays in this base. This is a perfectly acceptable trade. If it breaks down, I'm going to get max gain. Only a 2-week trade on this one. I like this one quite a bit. And then last, in the energy sector, I'm looking for something just on the opposite. I'm +1. I just want something that stays strong. The market has been really a non-event to this one. This is FTI is the ticker symbol. And you can see we've got a nice high base here, and it's trying to break out of this base. Every time it gaps down, there's buyers. Gap down, buyers. Gap down, buyers. Look at that. There are people out there that want in this stock. So I'm going to take a look at the December 19th, 43.45. The stock is right in the middle of this. That means I'm going to get about a 1-to-1 risk-reward ratio, and that's going to be a 50-50 1-to-1 trade. So not quite a +1 and not quite a +2, so I'm going to call this a +1.5. FTI. Okay, let's wrap this up. I left all of these because this is what I had last week. Number one, I had lower high, a warning signal. So again, we had these, I called them dark clouds on the horizon. The dark clouds over the market, hey, it's a warning. We still have those dark clouds. And in fact, it's got a little bit darker. Number two, I had bull market still intact, barely. And I added must recover this week. So let's say the market has a huge bounce next week and we close over our 50-day moving average. I will concede that the bull market survived by the skin of its teeth. If that doesn't happen, I will definitely be ready to say that bullish move is over. We're now sideways to lower. We just have to figure out which one. A close below 66.50 is problematic. We talked about that last week. That's basically right about where we closed. Lower prices here. There is a chance if this market really weakens below that 66.50, the accelerating selling could get even bigger. We could get a 5%, maybe even a 10% drop. I don't think that's where we are here. There's still buyers out there. We don't have the panic. We don't have the margin selling pressure. We don't have that yet. So I think that I'm going to need to see some lower prices before we get to that point. Everyone have a great week. And remember, this week, we are not doing any videos or live classes. We always take this week off, the week of Thanksgiving, and then we'll be back next week. Thanks for joining me. Bye.